Under the Finance Act of 2012, the Government of India introduced a tax to be levied on capital raised by unlisted companies. Since this primarily impacted investments made by angel investors, it came to be known as angel tax. The tax became applicable on April 1, 2013 and is levied on the amount received above the fair market value as income in the hands of a company. Resident investors have always been within the purview of the angel tax. Nearly a decade later, the government in the Finance Bill 2023 proposed to omit the condition of residency under Section 56(2)(7)(b) of the Income Tax Act, making it applicable even when shares are issued to non-resident investors. This was done to curb the circulation of illicit money as share premiums and not to tax legitimate investments.
So if the foreign company makes an investment at a premium more than the fair market value, then the differential between the fair market value and the price at which the foreign company has come in is taxed in the hands of the Indian entity. So if this angel tax is introduced, then technically you can say, suppose if they are making the investment of $100 into the Indian entity, and Indian entity has to pay tax upon the delta, that means the share premium, and assumingly suppose the competition of tax, competition of income comes out to be $25, and they have to pay 25% tax rate on this $25. So effectively, the amount of foreign investment in India gets reduced by $12.5.
This move has spooked startups and venture capitalists alike. They have approached the government seeking exemption for certain classes of investors and also sought some changes in the valuation methodology. The government has pointed out that startups which are registered with the Department of Promotion of Industry and Internal Trade, or DPIIT, are excluded from the purview of angel tax provisions. However, there are many startups or companies that are not registered with the DPIIT. They will come under the purview of angel tax. More importantly, the new regulations spell trouble for younger companies that are yet to register and might be looking for an investment fillip from foreign shores. Hence, this provision has the potential to significantly impact capital flows to startups and foreign direct investments, or FDI, in general. Does this mean then that angel tax is making India less attractive for foreign investment?
Yes, it makes India less attractive by making the regulation more complex and introducing the startups as well as possibly their investors to tax proceeding and things like that. But investment chases returns. And returns are dependent on the growth opportunities that are available for that capital around the globe. And I think if the assumption is that India is really an island compared to what's happening in the rest of the world, and India is where the numbers are, the demographics is, the investable opportunities are, they will possibly factor in the impact of that change and invest nevertheless. It does reinforce India's image as not an easy place to do business.
Now, with this new provision, if the foreign investor makes the investment at a price more than the fair market value, then it is getting taxed in the hands of the Indian entity. Now, exchange control also contains similar kind of a provision where Indian entity cannot receive less than the fair market value, cannot receive any investment less than the fair market value because it's an Indian entity. Indian entity has to benefit from the foreign investment. Similarly, Companies Act also imposes an obligation that Indian entity cannot issue the securities less than the fair market value. So if you see the total assimilation of the tax law, exchange control, and the Companies Act, I can't figure out a way how this particular angel tax can be implemented without adversely affecting the foreign investor.
There's a likelihood that the government will exempt foreign portfolio investors, or FPIs, and foreign venture capital investors, or FVCIs, registered with the Securities and Exchange Board of India or the Reserve Bank of India from the tax. However, these two categories of investors have minuscule exposure to startups. While FPIs invest in listed companies, FVCIs put their money only in large infrastructure firms. Experts also stress that this further reduces the ease of doing business for both startups and investors.
Sure, because I think SEBI registered FPIs were always, anyway, it was the route for listed investments and various other investments. And therefore, it will really carve out a set of investors from startups who would be receiving investments from SEBI registered FPIs. But registration as an FPI is also not an easy process. But if somebody was, I think, only willing to do, let's say, unlisted space, they would therefore have to basically undertake the formalities for registering themselves as an FPI and then become subject to the ongoing compliance obligation. Again, if you are wanting to promote ease of doing business, is that a way of achieving that?
Therefore, experts believe that the general anti-avoidance rule provisions should be sufficient to take care of the government's concern or unaccounted money dressing up as investment. While curbing the circulation of illicit money is crucial, they suggest the government needs to pick and choose its battles when it comes to making India a more attractive foreign investment destination.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.